Hello, everyone, and welcome to another episode of the Financial Advisors Want to Know podcast. I'm Catherine Tindall, a CPA with Dominion. We're a specialty tax and accounting firm for the wealth management industry. And on today's episode, I have a very special guest with me, Patrick Burns. He is the managing attorney at the law offices of Patrick J. Burns and formerly served as president of Advanced Regulatory Compliance, LLC. He began his career at a New Jersey firm before moving into legal and compliance roles within major financial service firms in New York and LA. He's a frequent industry speaker. He holds multiple FINRA and insurance licenses and is active in several bar and financial services organizations. So thank you so much for joining me today, Patrick.
Well, thank you very much for having me. I appreciate the invitation, and I know we have a lot to talk about today.
Yeah, and we connected over some conjoined casework that we had going on. So I'm looking forward to kind of both from our perspective on the tax side, your perspective on the legal side. Today's conversation, we're really going to go through the life cycle of the RIA and talking about the different stages that they go through, from the early stage where they're putting together the business and the legal foundation, to the mid stage, which is the growth of the practice, whether it's organic growth or deal making or a little bit of both, and then going through the late stage. So that exit plan of how are you going to sell the business? Are you going to do a merger? Sell to employees? How are you actually going to end up exiting out of the practice? So we're going to have a kind of pretty broad range conversation today over, what we see in the different stages of life for these firms. So
Well, that sounds great. I'm looking forward to it. And I think both of us work with advisory firms in all three stages: early, mid, and late stage. So all of those stages entail very different things.
yes.
But having been in this space for a number of years now, I can tell you that what used to be almost exclusively early stage RIAs has really just kind of flattened out. We've got very mature firms that have been at it for a while, and we've got firms that are in high growth mode. So now it's a much more evenly balanced tranche of clients in all three of those stages.
Mm-hmm. Yeah, though I see a lot of, maybe it's just this year and the kind of circles that I go in, a lot of people independent this year. I think more people going independent next year. It's, I don't see it slowing down from my side, but yeah, so I guess for us to kind of start in the first leg of things, when people are thinking about putting together these firms, and putting together that foundation to start off with, what are the things that the common pitfalls of things that they maybe aren't thinking about from your perspective on the legal side?
Well, I think from my perspective, as we've worked with advisors over many years, it used to all be focused on doing the basic foundational pieces. So the Form ADV, the client agreements, putting a compliance manual together. But over time, as we've seen advisory firms grow and encounter problems with departing advisors, partnership disputes, maturing and getting to the point where they want to sell the firm, I think the lesson that's been learned by a lot of advisors is, beyond the basic compliance foundational parts to put in place, also putting employment agreements in place, making sure you've got an operating agreement which is put in place. I think these make all the sense in the world. Advisors are always surprised when somebody gets up and leaves, or a partner says, "Hey, I'm out of here."
Yeah.
And by the time they call us, if they don't have a very strong employment agreement that makes sense, one that they've had counsel put together, or they don't have any agreement at all, they're kind of out of luck when there's a dispute. And it's a very valuable lesson that they learn, which is you really have to operate it as a serious business. And when it comes to things like a partnership, there's no reason in the world why you shouldn't have an operating agreement or a shareholder agreement to govern what happens, when it's time to sell the firm, what happens if one person wants to leave, what happens if somebody becomes disabled or dies, does their estate end up getting paid out? And all of these scenarios have played themselves out. And unfortunately, when we don't have anything on paper, it turns out to be a very valuable lesson. So when advisors say, well, I don't really want to formalize things, or I don't want to go through the trouble, there's a lot more reasons to put it in place than there are not to put it in place. So that's usually how I reframe the conversation.
Yeah, and I've had several, not several. I had one this year where because that's always my recommendation too. Sometimes people approach us, approach the CPA firm first. And, one of the things I always tell them is, okay, you're going to need to get legal counsel involved. You need to decide whether, when it's partners, whether you're going to be jointly represented, whether each of you want your own representation, which is, that's out of my realm to make that call. But I've seen this happen where I've told them, make sure because for people where it's going to be a multi-owner setup, if you don't talk through a lot of these issues up front and make a lot of these decisions up front, um, it's like getting married and you haven't talked about how you're going to deal with finances or who's going to take care of the kids or, things like that, where you need to have those hard conversations before you step into this relationship, because it's so difficult when you haven't had those. And you've, you're going to find those areas where you don't have alignment. And so I had one happen this year where they were going to form, their own entity. It was already they were already very far along in the process. And then once they started going through, before everything was executed and formed, they were going through the process of doing the operating agreement first. And they found that they actually had a lot of disalignment on the way that
Right.
they wanted to do things and the expectations in the relationship and how people were going to get compensated. And they thought that they were on the same page, but then once they went through that process, specifically things too, even on an annual basis of, well, how are you going to get paid and how am I going to get paid and how do we calculate that? Is it purely just going to be equity? Is there going to be components that are based on, do we have siloed books of business? Like, how are we, are we going to pay all expenses together at the entity level, or are we going to split these things out? Like, even just at an annual operating level, not even throwing in curveballs like, well, what if somebody gets cancer and has to go on leave for 6 months? Like, what happens then if somebody's disabled? Even with just some of those things, I've seen these deals get blown up just going through the
Right.
operating agreement process. So it's a lesson that you want to like have that blow up before you've gotten married, and it's now you're trying to like pull apart client lists and it's a total big mess.
I totally agree.
Yeah.
And, but before we form the RIA, if they're forming an RIA, I think it makes sense to talk about the partnership and make sure we have agreement on the foundational elements. And I'll tell you the most common reasons why there's disjointment or misalignment between partners is a couple of things, just kind of off the cuff. One is different levels of production.
Mm-hmm.
So
Yep.
if you have a mega producer and one person is bringing in 85% of the revenue, um, they're not going to be 50-50 owners with anybody. It's just
Mm-hmm.
not going to happen.
Yeah.
So, the business won't survive probably if that person gets 85% of the revenue and the other people are starved or, barely have their head above water financially. But, saying that person has to be, a one third, one third, one third partner and there's three people and they all get paid equally, it's not going to happen with somebody with that outsized production and contribution.
Yeah.
But at the same time, saying that the other people will, split the other 15% in half, they may not make it financially.
Yep.
Um, so we have to look at the other ways they contribute. Does somebody take on the CCO role, which is, kind of a thankless job in many respects, but it's important to the viability of the business. But there's ways that that can be compensated for, through some kind of special allocation to that person.
Mm-hmm.
Maybe they fill the CFO role, the chief operating officer role, but all the time they spend on these non-revenue producing activities, it does benefit the business, but it hurts that individual person's direct contribution to the business. So these are some of the conversations that have to be had.
Mm-hmm.
It's good to figure this out in advance and find out who's going to fill these very important roles. if it wasn't one of the equity owners, they'd have to hire somebody and pay them to do it. So
Mhm.
there's a lot of these conversations that need to be had. And then the other one is if there's a big disparity in terms of work hours, like one person is later stage in their career and wants to come in the office 2 days a week, and the others are, younger advisors and they come in, 6 days a week. They're there on, the weekends sometimes, and they're like, well, why is this one person never here? I think these are things you have to talk about and say, okay, well, what's everybody's, philosophy going to be in terms of, actually spending time in the office and, supervising staff. And if you can't figure it out now, it's going to be, a problem later on. So I think a lot of these conversations that take place up front, it just avoids misunderstandings and hard feelings later on. And, it's easier to solve these um, items when you don't have a live business with revenue and expenses, and it's easier to talk about them before you get started because most times you can talk through these issues if the advisors already know each other and they have some type of relationship. But other times it's just a complete meltdown and it doesn't work out, and then it's probably for the best that they didn't move forward with the partnership.
Exactly. And I've seen different styles too, where, a big part of the questions that, because it comes into the tax planning side on our side of just, okay, when we're thinking through entity structures of things, if you're going to need more into, you kind of just want to have the RIA just paying for overhead kind of expenses. And then really you've got siloed books of business going on. Um, if you have that kind of a setup, then usually the way we'll recommend doing like entity formations and things can be pretty different too. So it's a lot of the times having these conversations up front are really important because you'll find those lines, and maybe you start off with something that's more of that kind of model where you've got one entity, but then really majority of things are getting distributed down at the individual level, and then you're kind of responsible for your own book, kind of a setup. And then as you get, more integrated, maybe with the other advisors, you go for a more integrated model. But it's so dependent on what the operational outcomes that you want. And it's, even in some conversations that I was having this week, it's really where, for you as an owner group, where are the lines for certain things? What are the things that you care about? What are the things that you don't care about? Do you care about the hours or do you just care about the revenue? Um,
Right.
and then figuring out, okay, where are the lines, and then what's the operational outcome that you want to have with how are people getting compensated, how do you do that calculation, what's fair between the two of you, because you decide, as an owner group, what's fair, and so really deciding what's fair is a lot of this conversation. And then usually from the tax side, what we end up doing is backing into, okay, if this is how you want this to work, there's more or less tax efficient ways for us to get those dollars across the bridge. And so we want to figure out, you know, um, how can we do this the most tax efficiently, but also give you the flexibility to do it the way you want? Because the more flexibility you're going to need, the more likely it's going to end up being a complex entity structure. If you don't need a lot of flexibility and it's just, a dollar comes in, it gets split in half, and that's fair, and you both are happy with that, then great, we can go for something much simpler. But a lot of that, it's all those upfront conversations that you know need to be decided at the owner level. And I don't know if you've had this experience, but I've had it a bit where um, the advisors will say, well, Catherine, what do you think? What do you think's fair? Or what do you think we should do? And it's, a lot of the times I'll have the conversation with them of just, this is a strategic business decision. This is like an operations decision. Um, for me to tell you what I think, I can tell you what I see other firms do, but ultimately, you've got to be comfortable and sleep well at night with some of these choices, especially around how compensation is calculated. And
Right.
because that's where I find most of the frustration points. And when people leave, a lot of the times it'll either be I have more roles and responsibilities than I signed up for. I'm doing more hours than I wanted to be doing. I don't have as much freedom as I thought I was going to have, or I'm not getting compensated correctly for what I'm doing. And I don't, have alignment with the other owners. And that's why I'm splitting off and doing my own thing.
Right. I think that's very true. And I think also, one thing that happens too is ultimately it's a good idea to get together once a year and talk about maybe some changes and updates to the partnership or operating agreement.
Mhm.
And we've got one client situation where there's probably half a dozen people that weigh in on almost every decision. And what's happened is, that may have worked well when they were a startup 15 or 20 years ago, but they've kind of hit a ceiling where that's not really the most ideal or even a functional way to make day-to-day decisions.
Mhm.
And I've, been talking to them about, well, I think you have to dedicate somebody as your president to make a reasonable amount of day-to-day decisions without having to meet with five other people and get unanimous decisions on really, operational issues, things down to like, hey, we're going to buy a new office printer for $1,000. It's like, well, you know, you're tying up six people at the firm
Oh,
on things
man.
that this should be within the authority of somebody to just make a decision and everybody's okay with it. There's millions of dollars in
Yeah.
revenue. I could see like, look, if
That's
you
probably
wanted
just the front desk should be making that call.
right, but if you wanted to open up another office and sign a lease and everybody's on the hook for it, by all means, the majority or everybody ought to be on board with that. But there has to be some kind of sensible, discretion allocated to at least one person so that everybody else doesn't need to be unnecessarily brought into meetings and they can, continue to grow the firm and not just kind of plateau.
Mm.
So that's something that I think, could be resolved if they sat down, year to year and just said, hey, this isn't working anymore. We need to make updates to how we operate. So let's get that documented and think about how we evolve our processes. So I think that's one thing. The other is, we've talked a lot about the partners and the equity owners, but employees. Um,
Mhm.
I always think it's a good idea to have an employment agreement. I think it's a good idea to strongly consider an HR manual.
Mhm.
Um, the HR manual comes into play if you have a nightmare new hire and you can point to the manual and say, well, hey, we have policies on, whatever it is that you're, running afoul of in terms of our firm, or it's the long-term good employee that's gone bad. And, having policies in place will, help you if you have to document a performance review or ultimately a termination. So I think, putting in place some of the elements that bigger companies have, like an HR manual, an employment agreement to at least safeguard your clients, safeguard your data. These all are things that make sense. And by the way, down the road, if you ever wanted to sell your firm, all of the firms that do deals, they go through due diligence and they're going to ask you for all this stuff. So if the first thing you tell them is, well, we don't have any of that, they're going to become, very concerned about their exposure and how that deal is going to work out for them. So I know a lot of firms don't think about what will happen 15 or 20 years down the road, but
Mhm.
when you're sitting at the due diligence meeting and you're talking about, selling your firm and you don't have employment agreements, and you don't have an HR manual, and you've been sued once or twice, it makes firms nervous when they're thinking about writing a check to you and buying your business.
Yeah, or they're gonna try to ding your multiple in the deal, right? Like, and it's
Right.
okay, how much would it have cost to have gotten the HR manual versus how much did you just lose in asset value? Like, oof.
You
You
know,
know, that's
and
how I look at it
the
sometimes.
other thing too is, I've had firms that 5 or 10 years later they try to go to people and say, "Well, I want you to sign a restrictive employment agreement," and they're like, "No, I'm not.
Yeah.
Why would I sign it now? I mean, if we don't have trust by now, then maybe I don't want to work here." Or they look at the employment agreement and they're like, "There's no way I'm signing this. I mean, I'm free to leave now and take the clients with me, but after
Mhm.
I sign this, not so much. So why would I want to do that?" So you really get one opportunity front end to put the foundation in place and do things right. So
Mhm.
um, I don't really care how long you've known the team or what your gut instinct is or any of these other things. It's just not a reason to deviate from putting the normal, foundational pieces in place for the RIA and the legal front. I mean, we have too many horror stories for how things haven't worked out that it just doesn't make sense to take the risk. There's very little upside. If you drew, something on a whiteboard and you said, here's the pros and here's the cons, I could give you, 10 cons for not having these documents, but the pros, it's usually empty on that side of the whiteboard.
Yeah. And it's, I think one of the things that I at least experience, if you've got advisors who maybe say were W-2 before and then they're breaking off, is the initial extreme frustration that they experience with the fact of they've got a small, when they first break off, depending on how much business they can take with them, all of the sudden they're walking into this complexity level that is so wildly different from when you're a W-2 employee. For when you move from that bucket to business owner bucket, it's especially true on the income tax side of just now all of a sudden you're responsible for all of these income tax compliance requirements. You're now responsible for all of these other like HR requirements and legal requirements. And, the way that I put this with some people, especially when it comes to like tax filings and things like that, once you change categories, it doesn't matter if you're $1 million firm or a $10,000 firm. A lot of this basic infrastructure just has to get put into place. And so
Right.
just knowing ahead of time what that is before you make some of those moves, because, I always joke with people like it doesn't cost me extra to put an extra zero on that revenue, the revenue number on the return, right? Like it's a complexity ceiling thing. And I
Right.
think for a lot of them, they don't realize if they've not, if they're coming out of being an employee somewhere else and then going out on their own for the first time, that really you have to be thinking about, and especially if you've got multiple partners like that were W-2 and now they're switching into being business owners, it's just a very different experience. But like you were saying, when you're doing all these foundational pieces, you really do have to be thinking about the end in mind too, of just how are the things we're doing now going to affect our eventual exit? How do we eventually want to exit out of this? Because if I have two partners and one is going to be exiting out in 5 years and then the other one plans to stay much longer, well, then we probably need to figure a lot of that, at least some of the basic dynamics of that out now, because we don't want to build a structure that's going to be impossible for that first one to exit out of, even just at the
Right.
beginning. So I think moving from early stage to talking more about the mid stage, uh, talking about growth and the kind of the two big lungs, right? The organic versus the inorganic, and how those how those work, and a lot of people having both. What are some of the things that you see kind of after firms get from that early stage to, okay, we've got our foundation in place and now we're just kind of in that growth mode? Catherine here. Just wanted to say thanks for tuning into the show and hope you've been enjoying it. Since we're all at the mercy of social media algorithms, if you wouldn't mind rating the podcast on whatever platform that you listen to, I'd really appreciate it. And also, if you're looking to stay in the loop on current tax updates, what the firm is working on, and just the things that I think you as a firm owner need to be aware of when it comes to the world of tax, you can sign up for our newsletter using the link below. I only send out editions when we have really useful things to share or things that I think are important to have your attention and energy on. So let's get back to the show, and thanks again for being a listener.
Sure. So I think just in terms of the mid stage, the growth mode, we've got our traditional advisory firms that have done all of their business development through organic means.
Mm-hmm.
They've gone out, gotten all their own clients. Maybe they've gotten referrals from CPAs or other centers of influence, and they haven't done any deals. They don't want to do any deals. They're very comfortable in their space, and they've done a good job just building up their business really from scratch. But more and more, you're seeing advisors get educated and know that there's other ways out there to build a business.
Mm-hmm.
They look at these big RIA firms that do deals, and they want to be the next version of one of these large advisory shops. And, very few will reach that size and scale. However, there's very successful, stories of smaller firms that have done quite well doing, a small handful of deals. And that keeps track with their infrastructure. They don't have to hire too many additional people. And they might have the resources to pull this off without taking on really any debt or very little debt. They might do it out of their cash flow. So you've got that going on. I think when firms consider making the pivot from organic growth to doing deals, they just have to enter the deals making space with their eyes wide open.
Mm-hmm.
Because a lot of times when we're working with RIAs and they're doing their first deal, they're really so eager to get the first deal that they ignore a lot of the red flags. We had one recently. I wasn't involved in this, but I came on after the fact to help the client with some integration issues. But the seller was not a great personality. I mean, really, really overly difficult, not pleasant to deal with. But every single interaction between my client, the one that was the buyer, and this individual, it's the same, interaction. And, at this point, they have buyer's remorse because they have to deal with this person for the next couple of years on earnout. And it's just super painful.
Mm-hmm.
And, if they had listened to their gut instinct, they might have just walked away from this deal.
Mm-hmm.
It just probably, it was, not worth doing in retrospect. It's just, the issues that are raised are mostly just, how to work with this person's ego and their, quirky and, somewhat nasty personality. But these are all things that are greatly time consuming. They always have to walk this person off the ledge. Most of the things that are raised are non-issues in the normal course of deal making, but there's been so much wasted valuable time with this person that they probably should have saw some of these things before they did the deal and taken a pass. They could have done 2 or 3 deals with the amount of time that they dedicated to trying to make this one work. So that's a problem. And they have done, deals since then that have all gone off without a hitch. And, I think there were some lessons that were learned there. So that's one. I think others are just not doing enough due diligence ahead of time and asking tough questions.
Yeah.
We've had a couple of deals that, ended up not going through because the seller, put up roadblocks, saying like, hey, this is too time consuming, or, don't you trust me? And it's like, well, when you have, 7 or 8 figure, deals being consummated, it's not based on, it's not because we don't like or don't trust the person, but, if you walked into a bank and, tried to get a couple $1 million to buy a house on a mortgage, they're going to ask you to fill out an application, go through the gauntlet of underwriting. So nothing we're asking is, outrageous, but when we want to see, financials, we want to verify that the numbers are accurate. When we want to, look into past regulatory exams, see some of the correspondence, we're doing this because we want to know what our client's going to end up buying. And, when people don't want to answer questions or go through the normal due diligence process, that's a major red flag. That sets off all kinds of alarm bells.
Yeah. And I think another component too that some people don't realize, and another piece that's important when you're doing these deals, is also making sure that from the income tax piece, you're forecasting how that interaction is going to work.
Right.
Because sometimes, especially in some of the smaller deals where maybe the cash flow is tighter, you can end up with this effect of, if you're not financing things, so if they're getting funded out of profits, you can run into scenarios where, you're making these principal payments or you're making these large payments, but it's not a tax deductible activity. And so if it's coming out of taxable profits, you basically are effectively having to pay income taxes on, the cash that's going towards these deals. And so a lot of times what we'll end up doing as part of, it's usually more succession planning kind of things where it's a second generation buying out a first generation, is just making sure that the money flows are going to work. So how much expected revenue are we going to be getting? How much profit is left in the business after overhead? How are the owners going to be getting compensated? And then how's the debt going to be serviced? And how are principal payments going to be serviced? How's interest going to be serviced? And whether or not those things are going to be having to come from taxable or non-taxable buckets, because it can make a huge difference. And also change the way that, we want to get they want to push to get the deal done, whether it's a stock or an asset sale will make a big difference. So there's a lot going on with that. And I think maybe that brings us to the final point here, talking about late stage, right? In the exits, because you've got kind of you in the growth stage, you're on the buyer side. But what happens when you're finally at the seller side, right? You've built the practice, over time, and now it's time to figure out the exit plan. Maybe now that's not the time to figure out the exit plan, but now we're at the exit plan. What are some things that you've seen in practice firms struggle with, or areas that were surprising for them, kind of as they get to this late stage?
Yeah, I think a couple of things. One is it takes some time to package up and sell your firm. So I think you should think about it at least, 2 or 3 years out from the sale. You should start taking a look at your financials, your business operation. You can even have a financial audit done of your firm and have somebody come in, even like an M&A firm that does limited engagements. If they come in and you say, I'd like you to take a look at my firm. If you were buying my firm or you were the advisor for a buyer, how would you criticize my financials? Are there things that you would want to see stated differently? Are there practices with my accounting that you recommend we cease immediately? Tell me how legitimately we can look at our financials and our bookkeeping and recording practices, and let me know what works and what doesn't work. Because I think looking at your books before a firm, private equity firm or another firm rips it apart and says, we don't understand your financials, or this wasn't the ideal way to record things, you should really have somebody come in and take a look at them a couple of years out. Because what I found is, when you have due diligence being conducted on a sizable advisory practice, and let's just say it's a private equity firm that's running the due diligence, they definitely want to look back at least 2 years on your financials, maybe 3 years. You can kind of cut it off at 3 years, because, what a business looked like 4 or 5 years ago really isn't relevant to where they are today, unless they're declining, and then of course it's relevant.
Mm-hmm.
But a business from 4 or 5 years ago is not the business that's being sold, today. So I think the financials have a look back period of 2, maybe 3 years. Beyond that, things have changed, and the business really is not, what it was back then. So I like going through that process. I also think that taking a look at your operations and seeing if there's anything you can do differently. If there's any expenses that can be taken off the books, that would be helpful to increase your bottom line revenue and to help get your multiple up for sale. These are all, I think, very, very, helpful ideas to look at before you get to the deal table. And then, of course, when you do, by that time, hopefully your operating agreement is strong. You've got employment agreements with all your key people. You've got no, HR related complaints, lawsuits, investigations, other things that could be problematic. Buyers don't want to see this stuff. We've had RIAs that had, an open HR related, lawsuit going on or something happening. And, the private equity firm's like, you gotta you got to get this put to rest. We do not want to see this. This
Mm.
makes us very uncomfortable. It's not great. And as a matter of fact, when we come in and buy your firm, we're buying that liability. And if we publicly announce this is a big deal, maybe that litigant says, "Well, now there's a big bag of cash. Maybe I can ask for more, and I'll hang around
Yep.
and really pursue this suit." So they want all that stuff put to rest, or they're or alternatively, if they do the deal, they're just going to say, "Well, we're going to put some money in escrow, and we're going to
Hmm.
hold on to it, and we'll
Yep.
release it once that suit is put to rest." And if it's anything comes out of our pocket, we're just going to use those escrow funds. We're going to apply that towards whatever the settlement is. So all these things are areas where an advisor has to kind of come to the table with all these items in order. And I think when you do start shopping around or putting your firm on the market, um, real quickly, I think some of the considerations are, if you're selling an RIA, there'll be no shortage of potential buyers.
Hmm.
But the way I think you can start to whittle down the list is to look at the culture, look at your meeting with the executive team at the RIA. If that doesn't sit well with you, and you're like, "Well, I didn't really see the vision of the CEO," or "You know what, this isn't a person that I would want my clients to be under their commands, and I certainly don't want my employees working for them," then you can just cross them off the list. I think it's just not a good cultural or business fit. And I think that's
Hmm.
one area. Then there's the other ones. I say they've got big dreams and empty pockets. If you look at the firm and you're like, "Well, everything they say sounds great, but where are they going to come up with the money to get this deal done? They have no financial backing. All they're talking about is paying me out of my own cash flow, essentially.
Hmm.
I'm responsible if any of the clients, leave, and they're going to decrease my, payment stream. But they really have very little to put down, and I'm going to walk away at the closing with, hardly any cash out of this deal. So is that really the best constructed deal out of all of these?" And kind of a close second to that is, we just had one where the primary principal of the business got an offer from a buyer that was 70% illiquid equity in the parent company. And the guy's like, "I'm 70 years old. I want cash." I
Yeah.
mean, and they were talking to him about, I mean, it was almost like they were reading their business development script. They were talking about, "Well, it'll align our interests. You'll have a vested interest in our growth." And, he's trying to tell them, "Hey, I'm 70. I,
Yeah.
I don't I don't have a long time horizon. I'm looking to retire and move on, and what I'm looking for is cash out of the deal. I'll
Yeah.
take some equity, but 70% is not the right number for somebody his age."
Yeah.
He doesn't have a long horizon. If he was 50, maybe it would make sense, but the solution that they came to the table for with this guy was just not tailored to the person on the other side of the table at all. It was almost like they had like a prepackaged offer, and they
Hmm.
didn't look at the reality of the fact that, "Hey, my client's 70 years old. He doesn't have a long-term horizon. He doesn't want 70% equity with a multiple year holding period. It doesn't make any sense. The deal's not going to get done."
Yeah. Yeah. And I see a lot of firms where, and maybe this is just the circles that I'm in, but this is a conversation that we have early in the relationships with new clients is just, okay, what's the exit plan? How do you anticipate getting out of this? How long are you going to be running this? What are the things that you can be doing now? Like you said, for exit planning, like getting a lot of these things buttoned up is just going to make the better business for you to run as an owner, whether or not you exit. And then on top of that, a lot of what I'll talk to people about is, especially for very closely held firms. So for ones where it's a single owner or maybe just a close partnership group, they've organically built it up a lot. Maybe they've done a couple of deals, but it really is like their baby of just, do you want to take this to an outside person, or is the real ambition here, when they're in that growth stage, is the real ambition here you would like to see internal succession? Like, can you get employees or can you get internal people that eventually will be able to buy you out, and say you get some external financing for it? But, a lot of those kinds of things too. Like, I will see advisors where they go through that whole mid stage without thinking about some of these issues. And so once they get to the late stage, their options are limited because they didn't they didn't spend time trying to develop internal succession ability. Um, and so they do have to go external, and then it's just a very different experience. I don't know if you've had the same, with some firms, or can kind of speak to that situation, of like thinking through some of that internal, like, instead of going external for a deal and an external exit, how you can facilitate doing it internally.
Yeah, I think the internal succession works better when the person that's exiting is one owner among several. So if
Mm,
there's a couple of other equity owners and they're going to come up with a structure to buy out the other equity owner, I see those internal successions working much better and having a higher probability of being pulled off than the
mhm.
case where you've got a 100% owner that tries to sell it to their staff. They don't have the money to pull off the deal. They don't have they don't have the leadership in a lot of cases,
Yeah.
and they don't have any cash at close. So in those cases, if you're going to try to do a deal that way, if my client is the one with the 100% ownership, you know, first right off the bat, you're definitely doing this not on the most favorable financial terms that you could possibly get.
Mhm.
So, your lifetime of work is going to be sold at a big discount. So that's the first thing that you've got to be comfortable with. And you should probably talk to your spouse about it, because this is a very big financial decision that you're making, and you're
Mhm.
not going to get the most money out of this deal. And if the leadership and is not there when you're gone, when you exit, and if clients start to leave because they were mostly tied to you and you didn't develop the next gen, as far as the earnout and the payments you thought you were going to get, it may not be happening. So you've got to keep this all in mind. And sometimes also, if you were the 100% owner, that means nobody else was an equity owner. Nobody else has a non-compete. So what happens if you leave and one or two of the advisors take off with some clients? Well, that's going to blow out the revenue that you thought
Mhm.
you were going to get paid from. So those deals, I don't think, stand a high likelihood of being successfully executed on. I mean, we can do all the paperwork, we can put together the deal, but just in terms of whether it's actually successful, we look back and it was a great success story is another matter.
Mhm.
It's probably a higher probability of success if you had somebody that was a 25% owner. There's three other people that are 25% owners. They sit down. The one person that's leaving is a little bit older or has health issues or something's going on, and they're like, "Hey, I think I want to start to have the conversation about exiting." They just buy up their equity. I mean, we just had one where it was uh, it was basically three people that owned the majority of the firm. They
Mhm.
had a liquidity event where they sold 25% of the firm, and one of the three surprised the other two and said, "Hey, based on the liquidity event, um, I now think I want to talk to you guys about selling my interest in the firm, and in the next 2 or 3 years, that's enough for me. I think I'm going to move on." So
Mhm.
they were a little surprised, but after the surprise wore off, they're now putting in place a mechanism to buy that person out. So it's all going to be fine.
And so I think you highlight a really good point, which seems like a thread through kind of all of the stages, right? Of just the business has a life of its own, and the profession and how professionalized it is going to make a really big difference with how successful a lot of the getting through these different stages is going to work. And like with that internal succession piece, if you're trying to exit out of the business, but you haven't gotten rid of key man risk, like you just really haven't professionalized it as just an independent asset from you as the advisor, all of these stages are going to be difficult. Like they're going to be more difficult. And so I think a lot of the conversations that I end up having, when we're thinking about tax planning is if we've got, in any year, if we've got excess profits in the business, unless those profits are producing a return for you or you need them for personal use as an ownership group, really focusing on reinvesting that money into the process of professionalizing the business and getting it to be the asset that it should be. You're paying a lot of excess income tax on that. So like, I had a conversation with somebody the other day of just, okay, they had an extra 200,000 that they didn't need for anything personal. The business was in kind of between early stage and mid stage. And I said, well, what are the bottlenecks in the business right now that are holding you back from, for them, they were really burnt out. So like, let's dig into this. Like what's actually causing this? Because this is just the business as an asset is not functioning properly. Like if you as an advisor and the core owner are experiencing burnout, this business asset is inefficient. And so if it's producing enough profit that we can tackle that problem, let's tackle the problem. Why just pay income taxes on 200,000? Like if you can figure out how to deploy that, and that if the focus really is, you kind of have to put on two different hats of you as the advisor, especially if you're still doing technical work as the advisor, and then you as an owner of an asset, and kind of you judging yourself as an employee and you judging, okay, if I'm a passive owner of this asset, how is this performing for me? Like what's wrong with it? Like what's good with it? And how do I make it more efficient so that whether or not you exit, that's kind of the aim that you have in mind the whole time, is just how do I make this professionalized? How do I make this functional so that it doesn't need me? And then also that you've pulled out the key risk issues that a business will have. If you've got too much, concentration of too much revenue in too few accounts, like say you just have a couple whale clients, or too much risk concentrated in a couple of key employees that, if they walked off, you'd be in real trouble. Like it's really just de-risking the business, including yourself, you as the owner. What are the risks that you involved? You have your finger in way too many pies. Like how's, just so many different components of the business that need to be professionalized. And so I think having, it can be really challenging for people in service businesses in general, especially, I think for advisors to realize that you're actually like, you're kind of this split personality of you as the employee, you as the advisor, you as the one that's facing the clients, but also you as an investor, you as a business owner, and that you need to treat kind of those as two different people, two different perspectives, two different emphases, and, making sure that both are get, you've got two roles, and just making sure that both are getting met properly. But,
yeah, I totally agree. I think all of these stages are definitely important. And I think now with the RIA industry having matured and really been in hyper growth mode for the last 3 decades, advisors that go out, do a lot of reading, go to a lot of conferences, get a lot of industry education, you can really get kind of a master class in how to build a practice, and ultimately at the end of your career, exit and sell your practice on very favorable terms. But there's things along the way that you have to do, and you can't get buried in the day-to-day. You have to set aside some time for strategic thinking and execute upon that, whether it's internally or visiting with outside advisors that specialize in working with RIAs.
Yeah, absolutely. So for those listening, what is the best way for them to get into your world, to learn more about the work that you do, Patrick?
Well, definitely by contacting, my office, going to industry conferences, reading all the industry publications that are out there, Investment News, Advisor Hub. I find all of these publications always have interesting stories or topics, but there's a lot of, I mean, there's probably, a flood of RIA conferences out there that people can go to. But, I think any of the deal making or M&A type conferences are always of interest, to me. But I think even at the traditional sales conferences, they're not even sales conferences, they're really content conferences today because
Mm-hmm.
advisors know how to sell, they know how to get clients. They go to conferences to learn, the content and the things that are being offered in the technology realm, to see how advisors are doing things, to learn from their industry peers or the people that are, putting on the conference. They bring out experts. But I think these are all, valuable things. And certainly on the tax front, they should contact your office, have a conversation, and really think strategically, because I think for any business, whether it's an advisory business or another one, tax time is just when you're filing your tax return.
Mm-hmm.
But I just had a conversation with my accountant the other day about some things that we could do year end to make our tax liability look better. And you have to do that before December 31st.
Yep.
Or that's it. It's on to
I always
next
say
year.
it turns into a pumpkin on, other than retirement contributions, we're kind of stuck. But yeah, it's a good point. And I think, just to speak a little on the tax side too, it's a lot of people don't realize, especially with these advisor practices, once you start being pretty, successful and you get through that early stage growth, okay, all of a sudden now 40% of these dollars are just walking out the door to taxes. And if you only have someone that's making sure that the forms have been submitted correctly, but not actually helping you decide, okay, do we actually want 40 cents on the dollar walking out of the door? Or is there something else that we can do with this to make it more efficient for where we're trying to drive the business? Are
Right.
there, is there more of a strategy here that we can have with operationally what we're doing, so that we're not, I always call it, it's an efficiency drag, right? Like if you've got all this profit, but it's not actually producing, the profit isn't producing something for you. Well, it's inefficient because it's just getting hit with taxes.
Right.
So it's always a challenge, but I want to thank you so much for being on the show. Any final thoughts before we sign off?
No, I just think that we're going to continue to see the RIA industry do very well for itself. And I really think 2026 is going to be another banner year in the RIA space.
I think you're right about that. We'll see. So for those of you listening, I'm always interested in hearing your feedback on what you thought about the episode, what stood out, and any questions that you have or lingering thoughts that you want to share, because I find that really intriguing for the guests that we bring on, and then for getting our conversations kind of tied into where your thoughts are. So always feel welcome to reach out to me. I'll have posted around wherever you're interacting this links for how to get in touch with Patrick and his firm, and also how to connect with us more and learn more about the work that we do. But I want to thank you again for coming on the show, Patrick. It was wonderful to have you.
Well, thank you very much. We'll do this again soon. Thank you.